Hey guys, it's Sasha. A few days ago, I sold my position in Palantir, and the kids over in the Palantir fan club erupted with rage. How dare some random guy they don't know, they've never heard of, sell out of a stock that they are invested in? Because you see, real investors do not ever sell out of their positions. Real long-term investors don't get swayed by short-term market swings. Real long-term investors do not act on emotion. And how could you possibly have invested in a company and then flip-flopped a year or two later? That shows you have no conviction. You do not believe in the stock. That is a rough summary of the typical argument that a young whippersnapper pretending to be an investor makes when somebody sells a stock that they happen to be invested in, and it isn't their fault. These long-term investors have only been investing for about 3 weeks before starting a YouTube channel teaching everybody else how to do it. And the last time there was a financial crash, they were still walking around in nappies. We have this new generation of crypto bros with laser beams shining from their eyes, or a profile photo of a monkey that they spent $300,000 on, or whatever the latest trend is. And it's time to take a minute or two, because that's the maximum attention span of Generation TikTok, to explain why long-term investors do and should sell some of their positions from time to time. Because the first important lesson is that being an investor is not the same thing as being a groupie in a fan club. I know, how ridiculous a statement. I know this point will be very hard to swallow if your entire identity seems to be shaped by one random company. That's all you ever talk about. Maybe you even have a social media profile on a YouTube channel that is literally dedicated and named after one of these companies. Because there is this new breed of long-term investor who puts their entire life savings of $200 into the company that they decide is the future, and from that point onwards, no other company is of interest, and that company that you've picked can do no wrong. It is perfect in every way. You must never sell that position, no matter what. But I don't happen to be married to my stocks. I don't sit in echo chambers in random Discord groups all day discussing how that particular stock is going to go to the moon. The objective of any long-term investor is to identify companies that they feel are particularly undervalued by the market, whatever the reason. As a long-term investor, you make an assessment of what you think the sum of all future cash flows from that company to you are going to be, discounted back to the present value. And a company is undervalued if you think that the sum of those cash flows is greater than what the average opinion of the market happens to be at the time. Because you haven't got yet round to purchasing a crystal ball, you don't happen to know exactly what the sum of those future cash flows is going to be. So each time you make an assessment based on the data in front of you, and you make an educated guesstimate, if you like. The problem with that guesstimate is that it's going to be wrong. Sometimes you're going to be wrong in the good sort of way. You will have underestimated the future performance of a company. It surprises you and you keep increasing your target prices. And other times you will be wrong in the bad sort of way, where the company performance goes in the wrong direction. I am wrong the wrong way a lot. That is how investing tends to go. Now, when you are wrong in the wrong way, you have 4 choices. 1. You declare an oath of allegiance in a blind kind of way to your stock, and you do not sell no matter what because you have diamond hands, you are a dedicated ape, or you really don't want to quit the fan club. Number 2, you do some analysis and you determine that this particular downturn is temporary, or maybe not long lasting in terms of its effects, or maybe other metrics make up for it in some way, and the adverse performance is not material enough in your opinion to shift your long-term stock assessment. Number 3, you take note of the adverse performance and you don't like it much, but you begin monitoring the stock more closely than you have before, maybe looking at specific metrics and performance indicators that may indicate whether you think this is indicative of a longer-term change in your long-term thesis or not, and making an assessment over time. And number 4, the adverse performance is so bad that you have to revise your long-term thesis because the data you have obtained has fundamentally changed your opinion. You realize that your original thesis was wrong. And unfortunately, every successful long-term investor invests in losers over time. Everyone gets it wrong. One of the differentiators of a successful investor is that they know that they will sometimes be wrong and they know when to pivot. sitting on a losing position because of sunk cost, or because you're waiting for the stock to maybe go back up because you've lost money on it, or because you are a believer, is not a good reason to be invested in a company. Bygones are bygones. Every day you are making a financial decision. Every day you are deciding where is the best place for your money to go to work. It doesn't matter if you are invested in companies, sitting on cash, doing something else. Every day you are still making that call. Every day you don't sell a position, you are making the determination that it is still the best place for your money to be deployed. The day that you sell it, you determine that the decision has changed. There is no place for being proud or not wanting to admit that you could possibly have been wrong. And here is the thing. The sooner that you realize that you were wrong in the case where you were wrong, the sooner you can put your money to work somewhere else. But wait, it gets even more complicated, because when you make a determination that your original stock assessment was wrong, you might also be wrong. And often you will be. You will sell out of a stock and that company will go on to do well. That will happen a lot. It's happened to me before. It'll happen to me again. And sometimes the companies that you then redistribute your money into don't perform as well. That will also happen. But investing is not about hitting a home run every single time. It's not about getting every single decision perfectly bang on. You don't need to play the roulette table and make sure you guess the number every time. Investing is a game of averages. I don't need every stock that I invest in to be a 10-bagger. I just need enough of those every now and then, along with some slightly less well-performing stocks, to hit an average return of 20%, maybe, God, allowing 30% in the long run if things go well. You will not always be right. But if you're always making your investing decisions based on numbers, if you are continuously assessing your investments and every day thinking, is this still the best place for my money to be going to work? You have a far better likelihood of getting more right calls than wrong than if you just stick fingers in your ears and pretend that nothing is happening in front of you. Sometimes you are wrong because your assessment of the company's ability to grow was incorrect. Sometimes you are wrong because your assessment of the company's industry was off. Sometimes your risk profiling of the company was wrong. Sometimes you are wrong because the company just got disrupted, or the industry in which they were got disrupted. Sometimes a company just underperforms. Companies are made of people just like you and me, and they can also screw up and start performing badly for a million different reasons. There will be companies that I invest in for 10 years or longer. There will be other companies where I only hold a position for a couple of years. Sometimes I even don't hold it that long, depending on what happens. Then I sometimes will determine that either my assessment of the company was wrong or the risk profile of the company has deteriorated. There will also be other times when you actually get the decision right and you collect all of the upside that you see in the company and also sell out. As a long-term investor, selling your winners is just as important as selling your losers. Great companies can also become overvalued. I will sell out of the winning positions just as easily as I will sell out of the losing ones. If you are not continuously, critically reassessing your investments every single day, you are not a long-term investor. You are a gambler. Sometimes you'll sell because you were wrong. Other times you will sell because you were right. But if you take just one thing from this video, take this. Deciding which stocks to buy is a massively important part of being a long-term active investor. Deciding which stocks to sell and when to sell them is even more important.